Good morning, everyone. I'm Greg Frick, the F in HFO Investment Real Estate. On behalf of the entire HFO team, I'd like to welcome you to the 6th year of our ongoing Investor Roundtable series. Our program today will have an earthquake insurance market update from USI Northwest. Chase Bank is going to discuss a way forward in these uncertain interest rate environment. And the Oregon Law Group is going to talk about now apartments and how. We'll have a short Q&A afterwards, and we'll wrap it up at 1:30. Please note we have speaker feedback forms on your table for you to complete. Your feedback is very important as it helps dictate different speakers we're going to have in our various series. USI Northwest is a leading distributor of property and casualty insurance throughout the United States. They've been in the Portland market since 1912. Representing USI today is Heidi McCauley, Vice President of Property Casualty Division. Heidi's been in the business of property casualty insurance for nearly 20 years. Her primary focus is commercial and residential real estate. She's also a member of Metro Multifamily Housing and the local chapter of CREW, Women in Real Estate. Please join me in welcoming Heidi and discuss the earthquake insurance market update.
Hi there. So I just want to give you a very brief update on the earthquake coverage marketplace. But before I begin, keeping in mind that this is really just framed around earthquake coverage. This isn't necessarily talking about primary property coverage. And in order to really talk about the earthquake marketplace, we really do have to kind of talk about Japan. That seems to be top of mind and what everybody is focused on. Go back. What makes Japan kind of so extraordinary is that 4 of the 5 kind of costliest earthquakes and tsunamis have really occurred over the last 13 months. And so unlike years ago when Katrina hit, it wasn't on the heels of other billion-dollar events that had already started to impact the reinsurance marketplace. Japan's damage currently, they're estimating it at about a $35 billion price tag. There are certainly other models in the property casualty world that would even bring it closer to $100 billion. And while that in and of itself sounds like a big price tag, it will also now tack on to potentially the $20 billion price tag that's attached to the earthquakes in Christchurch, New Zealand. We've got the flooding in Queensland. We've got Cyclone Yasi in Australia. And obviously, as of front page news this morning, we're now going to start talking about the tornado that just devastated southwest Missouri, talking about Joplin, and already that now looks like an estimated $3 billion price tag. Hundreds of lives lost, millions of dollars of damage, and even more damage actually happening to buildings that maybe not a total, but certainly will impact what's going to happen going forward. What's also important to talk about is what happens if something hits here in the Northwest. And the Cascadia subduction zone is always and has been a hot topic around the Pacific Northwest. So in a lot of cases, we do think it's rather silly to talk about, do I need to buy earthquake insurance? Should I buy earthquake insurance? And typically what drives an owner's interest in purchasing quake is the affordability. Is it cost effective? Does it make sense? The Cascadia subduction zone runs basically from British Columbia to Northern California. And there's all kinds of different opinions about will it hit, if it hits. The reality is that the only place you can have a very large magnitude quake is along a very long fault, and Cascadia subduction happens to be a very long fault. It is a credible event. Really, the last event that was of any size magnitude happened in 1700. So we could sit around and guess again how much longer before it does happen, and really truly will it be a 9.0. So discussions around that. If, again, back to some of the modeling, if we do experience a 9.0 anywhere along that fault line, and it would affect Seattle, Portland, Eugene, down to Eureka, we're talking about a $104 billion price tag associated with that kind of a loss. So that kind of compares to the event that happened in Japan from a similar perspective. A harder market. We're already in a harder market when it comes to catastrophe insurance. So again, keeping in mind that your standard property liability policies that you purchase for your properties, flat renewals is probably what you'll expect. I doubt that there'll be a whole lot more competition going on out there as far as everybody trying to go to the lowest dollar possible. I don't expect to see any major rate increase. Again, that has a lot to do with your individual properties and the loss experience associated with those, but as an overall general rule of thumb, the property casualty marketplace is still pretty steady. The catastrophe marketplace, and as it pertains to quakes and floods and wind being obviously a much bigger issue in the South, that market is pretty much hardened up. And when we talk about a hardening market, we're just basically talking about pricing patterns pushing upward. We're going to lose the competition. Reinsurers will have, at least over the last 10 years, there's been lots of competition because the capacity has been there. And as long as there's capacity, there's room for rate. So capacity and rate will fluctuate. It depends on how much each of those insurance carriers have already committed to. We're already starting to see some balance sheets where some of the big insurance reinsurers have basically already spent what they budgeted for the entire year of 2011. So that's a little bit of a uh-oh. As far as what this all means to you as an apartment investor or current owner, we get tons of calls. We get tons of calls around, are my rates going up? Can I or should I buy earthquake? And the reality is that your earthquake, if you currently have it, very much good likelihood that it will go up. Typically what you'll find in a tougher market is that before an insurance company will decide to raise rate, they'll change terms. So where you may have been able to fully insure a property, that particular carrier might suggest a sublimit. So if you have a $10 million property and you've got full insurance on it, the terms they offer might potentially be a $5 million limit. Likewise, deductibles, because earthquake is catastrophic coverage, you're always going to see a fairly high deductible attached to that type of coverage. 2% has been the kind of the going rate. Sometimes you can manage with a really good insurance agent to get a flat deductible. I don't expect to see anything less than 5 and probably expect to see more like a 10% deductible. And it's important to keep in mind that that deductible applies to the value of that property, the replacement value of that property, not to the loss. So when you're talking, you know, basically a $1 million property, replacement cost, apply the deductible accordingly. As far as, again, insurance rates will rise in 2011. It would be great if I could give you kind of a chart that says I have a building built in 1985 and it's frame construction and it's 40,000 square feet and it's 200 units and I've done this and this to the property. I'd love to be able to give you a quick table that said for $5 million of earthquake it's going to cost you this much money. It's just not possible. Every carrier has a different way of arriving at rate. Some because of the fact that they've committed more capacity, their rates are going to be higher. Generally, older properties do cost more to insure. It's just the reality. Wood frame gets obviously better than brick because wood tends to withstand quake stress better. Premiums are also based on the nature of the soil around the property, and those are things that the insurance companies certainly have information and privilege to when they're doing the modeling. They're also graded on likelihood of quake. Again, we're back to what is likelihood. We've got Cascadia subduction zone, but again, I think likelihood is still fairly low on the scale as opposed to our dear friends in California. And because again, it is a type of catastrophic coverage, we've got deductibles that potentially are going to raise. So big message overall, expect higher premiums, less coverage, less capacity. And another question we typically will get is, if I do decide to buy earthquake, how much should I buy? And again, the market's probably going to help determine what limits are available. Obviously, ideally, you want to purchase enough to replace your property. You might have to settle for something a little bit less than that. And kind of just to wrap up, obviously, regardless of what you choose to do around your portfolio, whether you buy earthquake or not, whether you choose to buy lower or higher limits, being part of being a property manager or owner is always having a well-communicated disaster recovery plan. making sure that you let everybody know how and when you're going to react to any kind of a disaster that potentially could happen. So, thank you.
Feel free to learn more about our firm by visiting our website or calling us directly. Thank you.